Okay, good morning, everyone. Thank you for joining us today. The topic of today's webinar session is Mastering ICAAP, ILAAP, and Stress Testing post-COVID. This is part of our web series that we have been doing for the last 6 to 8 months as we cope and move on from the pandemic that the world is today living in. I would like to again thank everyone who have taken their time to join us today. With that, we'll start the webinar today. So before we start, I would like to give you a very brief overview about Aptiva. Kautuk, if you can. So as we speak, and many of of the attendees have spoken with us before, and also have had multiple discussions. But just for the interest of everyone, we would like to give an introduction about who we are. So Aptiva, established back in 2005, is an established service provider offering comprehensive analytical solutions for clients, specifically in banking, insurance, and financial services. We have created a niche for our clients when it comes to enterprise risk management, be it on an ever-changing regulatory or business environment. And also our current suite of offerings provides an cutting-edge solutions for be your balance sheet management, your impairment losses, your ECL computation, for your capital adequacy of computation, and portfolio analytics, and so forth. As we speak today, we have an experience of working with over 100 plus banks today across 30 jurisdictions around the world. We have customers in Americas, in Africa, in Europe, in Asia, where we come from. In total, if you see in our experience of the type of projects we do, we have since the time IFRS 9 has come in, we have done 20 plus IFRS 9 implementation projects where we have not only provide consulting but also automation services across different jurisdictions in Middle East, in Africa, and in Europe and Americas. If you talk about our model validation projects, we have done 1,000 plus model validation projects with 50 plus ICAAP and stress testing projects across the globe. In last few years, we have also, since our joining in Africa continent and starting our operations, we have been able to do more than 4 to 5 ICAAP and ILAAP projects with few of the leading banks in Eastern and Southern Africa. If you talk about our ALM projects, we have done 15 plus ALM, FTP, and ILAAP projects. And effectively, if you see, our experience has moved not only from the consulting services, but also providing us our clients into more of cutting edge, AI, ML based software solutions that is not only helping in solving their regulatory consumption, but also helping them and the risk managers to do more analytical tasks on their existing, sort of reports. So with that, I would like to also take this time to introduce our speakers today. Kautuk, if you can. So joining us for opening remarks is Mr. Mohammed Ozama. Mr. Mohammed Ozama is the Chief Risk Officer of First Bank of Nigeria, Ghana, who has 18 years of experience that spans across credit and market risk, corporate finance, relationship management, structured trade and commodities, finance, specialized lending, and other risk management. Mr. Ozama is a BSc and an MBA in finance. He is also part of as a senior associate member of Reman. He's also member of Chartered Institute of Bankers of Nigeria. He has worked in First Bank Chief Executive Annual Merit Award as well, as Best Support Function Officer in Credit Risk Management category in 2007. He has attended various senior management and leadership training and development sessions, both locally and abroad, which include Senior Management Program of the Lagos Business School, LBS, in SEED, Blue Ocean Strategy Program, Michigan Ross School of Business Executive Education, Positive Leadership Program, and many more to name. Mr. Ozama is also a DDI certified trainer and has facilitated number of credit and leadership training sessions at First Bank Training Center, where he's currently, sort of offering. He's currently based out of Ghana and looking after the risk management for the FBN subsidiary. in Ghana. Moving to the next speaker, who's going to speak on ICAAP, Mr. Kautuk Chaube. He's manager Aptiva, and he's been with Aptiva for over 5+ years. He has an experience of working in various risk consulting services as risk modeling, analytical development, and validation of Basel compliant credit risk models, PD and LGD, that effectively also help us in our IFRS 9 implementation. He has implemented and reviewed ERM framework for banks of different size and geography in India, Middle East, and Africa. In fact, our last 2 projects in Rwanda were also led by Mr. Kautuk on ICAAP. Today, he's certified with PGDM in Banking and Finance from National Institute of Banking and Finance. He has Diploma in Banking and Finance from Indian Institute of Banking and Finance. And also, he's an engineer in electronics and communication. The function and specialization today he looks after at Aptiva is on enterprise risk management, IFRS 9, credit risk modeling, BCBS 239, ICAAP planning and stress testing, risk solution implementation, and risk analytics. Our next speaker who's going to be speaking on ILAAP is Mr. Gaurav Gupta. He's an associate director with balance sheet analytical team from Aptiva. He has been with us for over 3.5 years with 10 years of experience in banking spanning across India, United Kingdom, Qatar, and has since joining our Aptiva team as spearheading the liquidity consulting and ALM advisory practice at Aptiva. Mr. Gupta is a certified financial risk manager from GARP and has done his MBA from in finance from NITIE Mumbai, and he's an IIT Roorkee engineer. The function and specialization that he looks after today at Aptiva is on liquidity risk management, IRR management, asset liability management, stress testing, cash flow forecasting, reverse stress testing, fund transfer pricing, behavioral modeling, and management reporting. So today, the session would be divided into 2 major parts, where Mr. Kautuk would be taking care of ICAAP and stress testing, and Mr. Gaurav would then take us through the ILAAP part of the session. But before we start the session, I would like to invite Mr. Uzama to give us an opening remark and also set the stage for the session today. Over to you, Mr. Uzama.
Thank you very much, Pratik. I'd like to most warmly welcome all participants, especially risk management practitioners across the globe, to this very topical and important section, webinar. As have been introduced, COVID-19 has practically put the whole world into a reset mode, and therefore a lot of challenges for economics, individual companies, banks inclusive, and the world over. In Ghana in Q1 this year, we almost experienced another lockdown, but government resorted to 50% capacity of offices. COVID-19 has disrupted so many parts of our lives, and we are gradually approaching what we call new normal, with most of our activities now becoming digitalized. And therefore, historical data that we normally will base our projection on are no longer as tenable as they used to be. And therefore, we need to begin to relook some of the frameworks that we have used previously, in previous times. Now, today we are going to be looking at the ICAAP and the importance, and also the ILAAP and its importance, and as well as stress testing. Banks are required banks are required to, from time to time, determine the minimum capital that they should hold to accommodate or support the kind of risk they are carrying at any point in time. And they are also supposed to periodically test the sufficiency and adequacy of the capital they are holding on a continual basis. Historically, these are based on static data, but post-COVID-19, what will be more relevant is resilience on a continual basis. In the same vein, the ILAAP liquidity, it has come to the realization of bank, especially after especially post the financial crisis of 2008, 2009, that liquidity is king, and liquidity is very, very important to ensure that banks continue to meet their obligations to depositors and customers. Therefore, just like when COVID-19 came, we all activated our BCP because we had a plan, and I'm sure not many of us had a pandemic as elaborate and far-reaching impact like the COVID-19. And a lot of stopgap measures have to be taken to ensure that we adequately deal with the unknown situation. The good news is that COVID-19 has been put under check, but it's not yet Uhuru, and therefore we'll continue as banks, continue to look at, plan for our capital, test the adequacy, and as well stress test from time to time, periodically. And most importantly, what should resonate is resilience. The LCR, for instance, provide for resilience within a 30 days horizon, while the net stable funds, the ratio also look at a maximum of 1 year horizon. But pandemic won't tell you when they are going to come. COVID-19 is not going to be the last, and therefore we should always be prepared. We are all living witnesses to how the pandemic has demystified the resilience that we thought some market had. The invulnerability of some market has been tested and challenged, especially health sector in most countries, tourism, education, entertainment, and so on. So it is my pleasure to welcome all of us to this very interesting and very, very important and topical in the time we live now. So once again, I welcome all of you to this section. As has been given by Pratik, Aptiva is a very, very experienced in these areas of ICAAP, IFRS 9, ILAAP, as well as stress testing, as you may have been told during the introduction that was given by Pratik. So once again, I welcome all of you. Thank you very much.
Thank you so much, Mr. Osama. And thank you so much, Pratik, for giving the overview. So before we begin, I would like to thank everyone for joining and greetings from our side, from whichever part of the world you've joined. I hope you guys are safe and just stay put and maintain the resilience. With that note, let me begin with the topic one for today, which is ICAAP. So beginning with the ICAAP, and let me also give you an idea about the way we are going to conduct this whole session, is that we'll discuss a few very basics about the ICAAP and stress testing in general, and we'll also discuss a few technicalities related to the Pillar 2 risk in the identification and measurement, and then we'll move on to the stress testing, a use test case, and also we will have a look at some of the challenges which are particularly being deliberated upon during the pandemic times. So with this, let me start the session for today with a very basic question, and which is basically the genesis of the ICAAP, and before that, the risk-based capital estimation as well. The basic optimization challenge which comes into any organizational growth. So this is a basic optimization curve that you have in front of you. Now, the x-axis of this basically represents the increasing risk, whereas the y-axis represents the increasing reward or the increasing returns. Generally, without the risk into picture, the organization or the bank would primarily focus upon the return side of it. But one of the shortcomings of the growth, which is not adjusted or not being challenged by risk, is that the growth does not have the potential threats or the cost of risk factored into it. So this is where the risk and the risk adjustment comes into picture. So it basically represents three very simple scenarios. Firstly is to reduce the risk. So by reducing the risk, one would try to create value, but basically shrinking the appetite, shrinking the growth, and eventually shrinking the book as well. So basically going from B to E. So when the operations reduce, when the growth reduce, obviously the risk also comes down. The second choice that an organization is basically the optimized reward. In this, the value is created by going from B to C. So you are trying to optimize into the curve, but in this sense, the risks are not increased. So in this case, the organization operates with a static risk appetite, and this also, after a certain amount of time, would hinder the organizational's growth and growth plans. Now, the third type of strategy, which is the most risk adjusted strategy in terms of its uses and application, is the increase in risk. So basically by this, the bank or a financial organization moves on both the cohorts. It continues to grow on its loan book, on its balance sheet size, but the risk measures also tend to be deployed into picture, because obviously the risk is going to increase. So in this manner, with a balance between the risk and the reward, the banks tend to move ahead, and most of the banks which have grown in size and yet have been resilient from time and again have followed this strategy. So basically, the crux of this optimization curve is that risk and capital are the building blocks of a financial institution's growth, and not the end result or not the end outcome of it. Now, with this, the genesis of ICAAP happened, and before that, there is the background of the capital that any financial institution is required to keep. So basically, capital safeguards the bank or the stakeholders of the bank, primarily the depositors, which is the easiest example, against any sort of adversity or any sort of potential risk. One of the most common ones is the credit risk. So capital acts as a buffer in such scenarios. And because all financial institutions are under the purview of regulatory supervision, there is a minimum requirement of capital being held by each and every financial institution. So the internal capital adequacy assessment process, or ICAAP, as a tool was designed for banks to undertake their own assessment in order to judge whether the capital is adequate or not. And this involves multiple principles which work under the whole framework. So the Basel Accord from which this comes out was primarily divided across three basic pillars. First is the minimum capital requirement, which is known as the pillar one. The pillar one defines the capital. So basically speaking, what qualifies as capital and what doesn't qualify as capital. Then after you have a stock of your available capital, you come to the required capital, that how much of capital should a bank be keeping. So for that, the risk-weighted assets, or also as known as the RWA, are seen across multiple risks that a bank is exposed to. Any lending institution would primarily be exposed to credit risk, then market risk, and because as a virtue of all the operations that it undertakes or conducts, it would also be exposed to operational risk. So these three become the basic risks or the pillar one risk. For all these three risks, bank need to capitalize. So again, going back to a very basic definition of capital, it means, and in Basel Accord, the basic spirit is that when an organization loses $100 of its lent money, the first hit should be taken by bank's own money, which is nothing but the capital. So that's the buffer which the bank keeps, or the regulator makes a bank or financial institutions to keep. Then the second pillar, or the supervisory review process, comes as the other side of the coin, which is the other side of the ICAAP. This is known as SREP, or in other terms, the supervisory review and evaluation process, where the supervisor reviews and evaluates whether the preparedness of the bank with regard to the capital adequacy is correct or not, and if it is adequate in all terms and covering all sorts of potential risks. Now, the third pillar, which is the last one, is the disclosure requirement. So from a transparency and market practice perspective, the Basel Accord also requires all the banks to have a disclosure policy and a set of quantitative and qualitative parameters on which the disclosures would be performed or undertaken. Now, as ICAAP is an internal process, it includes the pillar one risk which are to be accounted for, and it also includes pillar two risks which are not accounted or partially accounted under the pillar one accord. Now, moving on to the pillars of, or the principles of the pillar two accord. As we spoke, ICAAP and SREP are basically two sides of the same coin, and it's a feedback or a dialogue based process which happens between a financial institution and a regulator. So the two principles that a financial institution has to follow are that it has a capital assessment and measurement process, and then there is a process to ensure the adequacy of that process. So basically you are assessing the adequacy process that you have in place for determining how much of capital to be kept. Secondly, on the other hand, the regulator ensures that the ICAAP process within the banks are evaluated periodically, and it is ensured that the preparedness from the bank side is commensurate to its size and risk profile. Also, the regulators ensure that if any action or corrective steps are required in terms of bank's own internal adequacy process, it is taken in a timely manner. Then the banks internally determine or ensure that they always hold capital in excess to the regulatory minimum capital, so as to cover for any contingencies that may come across. On that note, the regulators also ensure that there is a timely intervention if at any point of time the regulators notice that there is a shortfall in the capital or the minimum required capital levels of the banks. So these are four standing principles on which the Basel Pillar 2 Accord stands. Now, for undertaking or for performing the internal capital adequacy assessment process, a bank needs to follow these four modules or principles. The first one, or the most important one, is to have a management and board oversight. So basically, because this process, which is ICAAP as a whole, requires input and integration from multiple dimensions and multiple entities within the bank, it is extremely important that this is overseen by the board and the management of the bank. So the bank, through its board and management, basically formulates a risk appetite which is in line with the growth and risk strategy of the bank, and sets its appetite or tolerance across multiple risk and growth based indicators. So it basically states that given the bank's own business and risk profile, how much of risk can the bank take or tolerate. Then, according to this, the policies are laid out. Policies become the guiding manuals or the guiding procedures for the rest of the process to be undertaken. The second principle is the sound capital assessment. This begins with the identification of all the risks that an organization is exposed to. So the organization first identifies all the risks that it is exposed to. It covers particularly the pillar risks, which are mandatory, and then the pillar 2 risks, which may vary across different banks of different nature. Then after the identification, the next step is to measure the risk. So once it is identified that the bank is exposed to a certain risk, the next step would be to measure so as to what extent or what threat potentially that risk can cause. And finally, once the measurement is undertaken, the bank has to come up with an approach to convert this measured risk into a capital level, or basically capitalize and cover that particular exposure. The third principle is basically the comprehensive risk assessment process. So it covers all the risks, whether it is pillar 1 or pillar 2, and there is a detailed process in which the measurement of that particular risk is being done. So basic pillar 1 risk like credit, market and operational risk are through regulatory guidance, whereas the other ones generally regulators provide liberty to the banks to come up with their own approach. So the guidance is more prescriptive from the first 3 risks that we are getting to see, which are pillar 1 in nature. Then comes stress testing. So basically stress testing stretches and tests the resilience of bank's own measurement process of the risk, and tests whether the bank's own measurement and the level of capitalization is sufficient enough or not to cover all the contingencies which are plausible in nature. Then there is internal control review. So through internal and external audits, it is ensured that the bank complies with all the regulatory and the pertaining guidances, and plus it also ensures that the undertaking of the ICAAP process as a whole is done through the assigned roles and responsibilities. Finally, once the entire process is completed, comes the risk monitoring and reporting. So it passes on the analysis, the reports, and in terms of the findings to its management board, and then on to the regulator as well. So with these 6 principles, it completes the entire ICAAP process, and this is how generally and typically banks undertake this process. Now, getting into more details in terms of a bank's role for ICAAP. Now, in terms of a bank's role for ICAAP, as we saw that it begins with the governance. So the governance acts as a overarching layer where the policies are formulated, the risk appetite, which is the guiding document for the bank, is formulated, and plus there are different designated teams within the senior and middle management, which tend to oversee different components of this process. Then comes the capital estimation or the capital measurement process, in which qualitative and quantitative risks are measured and then are capitalized in the manner that how much of capital would be adequate to cover that portion of risk. Now here certain risks are quantitative in nature, which are in the sense are completely quantifiable in nature, whereas the other risks are not completely quantifiable in nature, and they have to be measured in a more subjective manner. So once this is done, then the stress testing basically stretches and checks the adequacy of this capital and showcases whether the whole process is resilient enough and the measurement is sufficient in order to cover any upcoming stress scenarios. This is not only done at a stock of financial statements, but also is done with a forward-looking nature, in which at least 3 to 5 year, which is an industry practice, it is seen across that length of horizon. Then once this is done, the documentation basically covers from an operational perspective how this whole process was undertaken, what sort of controls the bank had put in place, the governance structure, the whole process in terms of different entities being involved, and every other detail which is required in this particular direction. So this document at the end forms the ICAAP report of the bank, and which is then passed on to the regulator. Then the regulatory role over here again is basically to focus on the management of the bank in terms of its own internal process, and to ensure that the bank undertakes this ICAAP exercise in line with the guidance provided from the regulator and the industry best practices. The regulatory interventions are done at junctures where the regulator feels that the sanctity of the ICAP exercise is under threat, or there is any constructive development that the regulator wants to intervene and point out towards, or there's any change that it wants to bring in. And plus also from a benchmarking perspective, so because the regulator is a central authority, it has a view of the entire banking or the financial sector as an industry. So it also brings in the benchmarking perspective into this whole exercise, and would be able to see whether there are certain banks which are above and below the average, and then accordingly the corrective actions can be taken. So basically this is a two-stage process, or a two-way process, in which once the ICAP is finished, the other part of this is the supervisory review and evaluation process. Now, moving on to stress testing. As we've seen, stress testing is embedded within the spirit of ICAP. However, there are a lot of banks and local regulators which also focus upon stress testing to be undertaken as an independent exercise. And today, particularly during pandemic, a lot of banks and regulators have realized that the utility or application of stress testing is beyond only the regulatory compliance, and stress testing should, or the outcome of stress testing should be used in all these spheres of management. So basically, this not only impacts the bank's own vision or forecasting process, but also raises the alarms early enough so that banks can take corrective and remedial actions. So again, because this is closely in line with the bank's ICAP process, this too has a governance and an overarching policy which makes sure that the whole process is run smooth within the organization. And this is particularly important, that as you notice that the inputs come from different entities within the bank, and hence it is required that the whole process is knitted tightly through a governance process. Then obviously the risk appetite statement becomes the starting point of any stress testing framework, because any breaches in risk are being observed in the existing appetite of the bank. So the risk appetite is being formulated across different financial parameters, and then through stress testing, a bank observes that under what scenario and under what amount of stress those tolerance limits would be breached. Then comes the stress testing process. So as in the case of ICAP, stress testing 2 starts with the identification of risk. Basically, the banks have to identify what risk it is exposed to. For pillar 1 risk, generally, uh, there is no deliberation required, because all financial institutions are exposed to pillar 1 risk. The extent may vary, in the sense that one particular institute may be more exposed in terms of its market positions and would have a higher market risk, whereas the other institution may have a very limited market risk, but probably more of credit risk on account of its loan book and its lending profile. So with this, the bank first identify what risks it is exposed to, and this happens through the interview of the top stakeholders, meetings and workshops, particularly important for the pillar 2 risk. Then there are internal surveys and checklists being formulated, through which different scenarios are designed across those particular risks. So for example, the bank may decide to undertake a climate risk based scenario, whereas the other bank may be more inclined to not take it, but would be undertaking an IT or a cyber risk scenario, because its more towards the side of the digital lending or maybe a new generation bank. So this is how the banks can take their own decision in terms of pillar 2 risk being included in the stress testing. And then because it is an optimized or a customized framework for each bank, and there is no one size fits all, there has to be customized risk tools for performing this. Then comes the assessment of the risk. So once the identification has happened, the bank has to see what is the scope of this particular risk and to what portfolio it impacts and how much is the exposure which is getting impacted. Then it is observed that what is the impact of the macroeconomic environment on this, whether the risk comes from within the bank due to bank's own lending exposures and bank's own market exposures, or whether it comes from outside. So this is also done by stakeholder meetings and through different analysis that the pertaining team undertakes on the bank's own data. And finally, the identification and measurement of the material risk is done. With this, then we move to the next part, where the measurement in terms of the sensitivity and the scenario designing is undertaken. So this begins with the sensitivity. So for example, if a particular portion of my lending book per se is sensitive to the movement in oil prices. So the first question you may ask is how sensitive it is. So it may be the case that with every dollar dip in oil price, you may have an increased risk, which would be reflected via your probability of default, and which would then translate in your increased provisions and your increased capital as well. So that's basically how the sensitivity analysis is undertaken before the scenarios are designed. Generally, in designing scenarios, as we discussed, apart from the pillar 1 risk, the other pillar 2 risks which are included are the liquidity, interest rate risk, and the other subcomponents of the operational risk. So then once this is designed, the contagion effect is seen, and this again it depends on bank to bank and given their particular risk profile. So these sensitivities are seen across key indicators like capital adequacy ratio or CAR. And finally, it is determined by whether on bank's income or bank's balance sheet, how the impact eventually flows. And then once this is done, this is eventually transferred to estimate the required capital and provision, and along with that other parameters which we are going to see further as we go ahead. And then once the stress testing is done, because again, as an end outcome of this exercise, the bank has to determine what decisions need to be taken. The banks reduce, accept, transfer, and avoid particular risk based on the outcome of this. So after the results of stress testing are out, the banks may choose to take or accept certain levels of risk as is if they think that the tolerances are not breached. Even in the most extreme scenarios, they would continue with the same level, or they may choose to reduce certain exposures proactively if they think the risk is beyond the tolerance, or they may also choose to transfer the risk through different measures like hedging or insurance or selling a certain portion of the portfolio, and finally avoiding or transgressing through a certain portfolios by reducing the sizes, which is one of the most common measures. So this is how the end-to-end stress testing process is undertaken, and the final outcome is that bank has a revised view and a revised strategy for its growth and movement. And then as an outcome of this, the risk appetite and tolerance limits are revised, and also the limits are then in line with the most updated view of the bank. This is a quick overview of how the stress testing is undertaken in terms of the scenario designing and the impact translation. Now, as we discussed, there are multiple factors which may be internal or external to the bank, which become the source of the risk. So it may happen that a hampered economic growth, the dip in oil prices, the movement in interest rate, the movement in forex risk. So this is basically systemic or macroeconomic risk in the sense it is agnostic to the fact that what the business profile or the risk profile of the bank is. Although the extent may depend on bank's own profile, but these are generally agnostic to bank's own internal risk profile. Whereas there are certain factors which vary from bank to bank. So for example, banks own concentration in large borrowers, banks own concentration in, say, non-investment grade exposures, banks own operational risk related hazards like model errors, banks own open FX positions, and aspects like that, which are not dependent on the macroeconomic or systemic conditions, but are due to the virtue of banks' own positions. So given both these sort of risk, there are different scenarios that the bank needs to design. So market-wide scenarios would mean that the defaults would go up if the macroeconomic conditions are stretched. So obviously, with every 100 basis point dip in the GDP growth rate, you may notice certain corporates going into default, and which would obviously increase the credit risk of the bank. Similarly, on bank specific risk, even if the macroeconomic conditions do not change materially, it may well be the case that banks exposure into certain top customers or depositors or any particular open positions may negatively impact the bank, which may not be the case for other banks. So this is very bank specific, or in terms of risk, as we say, idiosyncratic in nature. And obviously in a practical scenario, you would also see a lot of combined scenarios, because in a practical time, it may well be a combination of both, that your internal risk profile is also hurting the increased market or credit risk, but also the adversities are coming from outside, given the macroeconomic conditions worsening. Now, generally, banks would want to undertake this stress severity across different levels of risk. This is more from a management understanding perspective, and then the impacts are seen on the financial statements across different key parameters. So banks need to ask a question that if this risk was to materialize, what is it going to hit? So the answer would be, this is going to hit my increased provisions, increased provision requirements, and because the provisions flow from my PNL, is going to hit my PNL. This will impact my requirement of the risk-weighted assets. Again, the risk-weighted assets would mean that there is a higher capital requirement, and again the higher capital requirement would take a hit on my retained earnings and then to the PNL. And then there are different other measures like the earnings, the profitability, and also different capital adequacy related parameters on which the banks can observe the impact of these stress tests. There are other parameters which are related to liquidity risk and the interest rate risk, which we are going to see in the second half of this webinar today. Now, to give you a use case example, so what we are seeing right now is one integrated stress scenario. So generally, at the beginning of a stress testing framework or program within the bank, banks tend to undertake the risk on a silo basis, meaning it would be assumed that either the credit risk is being invoked, or there are certain defaults, or there is some adverse movement in the market which causes the liquidity risk or some market risk. Whereas in practicality, and the best example of which is COVID-19, it is noticed that all the risks are generally integrated to the extent that with one macroeconomic or major event at the focus or at the core, there are multiple risks spurring out of the same event. So for example, if there is a global recessionary event or a protracted global slump, so that protracted global slump may lead to liquidity shortage in the market as a whole, whereas the same would happen with the bank as well, because the bank's risk profile is also maintained in a manner that it is susceptible to a very quick liquidity shortage, and which is also aggravated by the increased liquidity cost into the market and the increased liquidity shortage in the market. So this causes the liquidity risk, whereas because of the global recession, the adverse market conditions in the region also impacts the bank's capital and earnings, which eventually impact the AFS valuation losses and the FX positions as well due to adverse movements. The same recessionary event also causes multiple credit risk related events, like it may cause rating downgrades of multiple key borrowers that the bank has exposure upon. It may also cause them to slip in terms of IFRS 9 staging, and we'll see through the ECL related models how this impacts banks' provisioning requirement, which eventually then translates into the ECL provision requirements, and then also in the increase in RWA, which then basically translates into increased capital requirement. And then there are other losses like increase in the operational risk during the same time, and also the interest rate sensitive assets and liabilities take a hit due to the adverse movement in the interest rate risk. So it is basically one single recessionary scenario causing all the risks in tandem, and which really makes it important that all these scenarios or risks are seen in an integrated fashion and not in silo, because observing these risks in silo would lead to an underestimation of risk. With this, we'll quickly have a look at the Pillar 2 framework. So Pillar 2 framework, as we've discussed, starts from the ICAAP governance, then basically translates into the risk appetite policy and the statement, which has tolerances across different risk parameters. And then it moves on to the assessment and measurement of those particular risks, which is then integrated towards the capital planning process of the financial institution. Now, this is an important juncture because capital planning before the integration of the business and the risk was purely a business-driven process, whereas right now most of the banks undertake capital planning through a feedback loop or through a feedback process in order to maintain the adequacy well above the regulatory minimum, and also to ensure that apart from the regulatory minimum, it also has sufficient buffer that can be utilized during these stress times. So with this, the whole process then is summed up into an ICAAP document. And this is how the Pillar 2 framework is embedded within the whole ICAAP process. So as we were also talking about different Pillar 2 risks being measured in a different form, this is an overview of how industry in general sees and manages the Pillar 2 risk. Now, these are some very commonly assessed Pillar 2 risks, and this overview gives you an idea about what sort of risks are managed quantitatively and what sort of risks are managed in a more subjective manner. So as you can see, the credit concentration risk, there are multiple approaches which are completely quantitative in nature and require very little subjectivity from the modeler or from the person who's undertaking the risk. A few examples are HHI based approaches or any variant of HHI based approach like a normalized HHI approach. Also, there is one approach called granularity adjustment approach, which is a more sophisticated approach. Yet there are pros and cons related to the data preparedness of the bank. So in this also, one of the important portion that any bank needs to keep in mind is basically what is the extent of prescription that the particular regulator provides. So for example, just to give you an example, most of the regulators are non-prescriptive in nature. So it would be specified that the bank needs to measure concentration risk, but what approach needs to be taken for that is left on to the bank to decide. But there are certain regulators like Bank d'Espagne or some other European regulators, which also are prescriptive to the extent that they prescribe the approach and also the thresholds which are required for the measurement of Pillar 2 approaches. Then liquidity risk also is completely quantifiable in nature. There are multiple approaches present today in the market through which this risk can be measured. However, risks like the strategic risk, the reputation risk, the regulatory risk, and other compliance related risks are still at such nascent stage in terms of measurement in the industry as a whole, that they are generally dealt in a manner which is more subjective in nature. So one of the more common ways is through a workshop based approach. The banks formulate a response sheet or a simple scorecard, and through which the scoring or measurement of that particular risk is undertaken. So this is the whole gamut of Pillar 2 risk. There are more risks which are very specific to certain organizations like the IT risk, cyber risk, climate risk, even certain banks do tend to measure pension risk. So this depends on bank's own assessment of its exposure. Now, with this, we move to the final part in terms of the ICAAP and stress testing bit that we wanted to cover. And these are certain challenges that in terms of questions we want to leave the set of attendees and panel over here. So the first question that, these times ask, and which are also the other side of the application of ICAAP and stress testing, is the solvency and sustainability. So the first question that any organization needs to answer is that, do we have enough capital to survive or to live in the target risk profile? So a bank may have a 5-year plan that these portfolios need to expand, and the other portfolios where it can tolerate certain amount of risk, but given the stress condition, it needs to check again whether there is sufficient cushion available. Do our risk exceed our risk appetite? So banks have to be mindful of the thresholds for different risks, and particularly a few risks which require even finer monitoring, that there is no threshold breach in particular parameters. Can the available capital finance growth the project, can fuel the projected growth in assets and risks? So obviously bank needs to check its stock, that the projections, if they can be met or not, or if there's any revision required in terms of its overall strategy. The second is regulatory dialogue. So regulatory dialogue, the regulators also need to deliberate whether, say, a current set of minimum is enough or not. So for instance, if 13% is the right capital charge for a bank during this time, and how also to avoid additional capital charges, because the other side of this regulatory minimum is that banks do tend to struggle during these tough times for capital, liquidity, and the provisioning requirements. So it is also important and imperative to maintain a balance between the two, and ensure that the regulators do not pass on any additional or any unnecessary capital or provisioning charges onto the banks. Then third is limit setting. So banks need to determine how much of risk can they tolerate for a specific country, industry, sector, or entity. This also then translate towards the portfolio analysis. So through portfolio analysis, bank need to determine what the true dangers are, in what portfolios there is an increased threat, and in what portfolios there lies any implicit trades or hedges that it needs to have a relook into. Now, this also has an impact on the RAROC, which is risk adjusted return on capital, and the economic capital estimation of the bank, that which products or segment are consuming the capital with a greater extent and in terms of value are lower than the other ones, so that the decisions can then be realigned to it. The next one is balancing member value. So basically, the regulators, which are the system overseer and the bank, need to determine that whether the economic pricing of the exposures and the relationships have been factored into correctly, so that both the parties remain risk-free through these times. And the final two questions pertain to stress testing, basically stating that are we underestimating given the current conditions, and finally asking whether can this happen or not. So once the scenarios are simulated, the banks need to ask that whether this is sufficiently stressed, this is plausible in nature, and can this happen again. So for instance, 2008 crisis, the bank needs to ask question that will this mimic again. So basically, these are the set of questions that ICAAP and stress testing answers even at these tough times, and that's the reason why banks across the globe are relying on these two measures to steer through. So with this, I'll pass on the baton to Gaurav for the purpose of ILAAP, and at the end, I think we'll have some time in spare for the Q&A as well. Thank you, Gaurav.
Thank you, Kautuk. Can you please move on to the next slide? Yes. So in the last, Kautuk has mentioned something about then the financial crisis or the global financial crisis in 2008. And I will say the genesis of all those liquidity regulations which we are seeing right now is that start of that financial crisis. Prior to the financial crisis, it was assumed that given an institution has enough capital, it will always have access to liquidity. But those assumptions fall through once when we see the Lehman crisis or the West Bank, all those banks in America, which have enough capital, they are quite solvent, but they have a short-term mismatch in the liquidity. That's why they fall. Now, coming to the is like in the first screen, we have seen the risk and reward from a capital and a risk perspective. Similarly, that same scenario we can see from a liquidity perspective. Generally, for a bank, the ALCO is the main authority or the main committee which is related to that liquidity risk management. In ALCO, we have a representation from risk, who is mainly concerned that whether all the material risks which are on the balance sheet of the bank have been factored in, have been monitored accurately, and are we prepared for any unforeseen event. This is the view of a risk manager or maybe of a CRO. From a strategic planning, this must be mainly the view of the CEO. That his main idea will be whether our net interest margin are protected or are we taking enough risk to grow, or whether we are within our risk appetite. And from a CFO perspective, who is mainly responsible for the capital management or the funding management, that what is the right level of liquidity our organization should have, or what is the right level of funding profile which our organization should have. So that liquidity risk management is generally, and somewhere along this line, whether we take it from a risk perspective or from a strategic planning or from a funding and capital management, liquidity risk is embedded in all of those three. Liquidity risk is not something which is treated separately or something which can be completely isolated. It is involved in each and every aspect of capital management, interest rate risk management, because every transaction in a bank has some inflow and outflow associated with it. Kautuk, next slide, please. Yes. So just as I started with the all this genesis of the liquidity regulations which we are seeing right now is on the global financial crisis. As we already know that the dependency just prior to the global financial crisis or up to the build of that GFC, that most of the banks assume that the funding is available in the wholesale funding market, and that too on a short term nature, and they borrow that short-term funding and invest or deploy those funds in normal project finance or in normal mortgage-backed securities. And excessively on and off balance sheet leverage, there was no pricing aspect in terms of if the risk the business is taking, whether it has been properly priced or not. So all those things are something which are not properly pricing the liquidity and not properly assessing the liquidity risk which any particular asset or liability product is bringing on the balance sheet. And these are the outcomes like the failure to maintain the confidence of the market in its liquidity and solvency. Because if we take historically, most of the banks which have been going bankrupt, so generally the underlying genesis or underlying crisis which was there is on the liquidity side. So the market lose confidence in that particular organization, in that particular financial system. People withdraw their money. The bank resort to selling of the assets at a higher haircut, and that's why this the liquidity crisis translates into a capital erosion kind of thing and ultimately a bankruptcy of the bank. So all those things are quite interrelated. And the next and out of this the global financial crisis, we have seen something like the too big to fail or too interconnected to fail, and for which we have again other set of regulations. For example, a higher capital charge or the counter cyclic capital buffer or the recovery and resolution planning. So we will be now focusing more on the liquidity aspect. So yes, in the next slide, what we are seeing, these are the initial responses of those regulators. It started with Basel and then followed by the European Banking Authority, PRA, US regulator, Gulf regulators in Gulf and regulators in African region. And this is almost quite standardized in terms of implementation, in terms of definition and approach, that the banking institution should follow or should compute two ratios. One is on the short term liquidity management called as liquidity coverage ratio, and another is on the assessment of the stability of the funding profile called as not net stable funding ratio. And both are required to be greater than 100 percentages. And most of the banks carry a buffer over that 100% to have any unforeseen event or to manage those unforeseen events. The idea of liquidity coverage ratio is to have enough of cash or cash generating assets called as high quality liquid assets to provide a stressed outflow for the bank for the given 30 days. And from a net stable funding ratio, we assume that all the long-term assets should be funded through long-term liabilities. So that the issue which we have seen with that in the crisis situation where short-term funding is supporting all these long-term assets should not reoccur again. So this is the way that net stable funding ratio, if it is more than 100%, so there's a confidence in the banking system that yes, indeed the assets which are long term in nature are indeed funded by the long term liabilities, or there is a high chances that these liabilities will get rolled over, so that's why they are getting a higher rollover rate. Yes, in the next slide we will come to that ILAP approach. So this the LCR, NSFR and other similar ratio. This was the first approach given by the regulator, and then they come similarly like because we have all we means as a financial sector and the regulators, they all have quite a wide experience in terms of ICAAP, because it is a common understanding and also an expectation that the bank knows their risk better. So the regulator can prescribe only three basic stress like credit, three basic risks like credit risk, market risk and operational risk. And all the other risk, for example liquidity risk or a strategic risk or the interest rate risk or concentration risk, so these are the risks which only the bank is in the best position to estimate and provide or keep capital against those. So on that same line, regulator started with that ILAP approach called as internal liquidity adequacy assessment process, in which it is assumed they means regulator will prescribe certain risk factors that banks should assess their balance sheet on those risk factor and provide liquidity for those risks. So here the approach is similar to ICAP, where the assessment of risk is given to the bank, and instead of providing capital you need to hold liquidity. And we will come towards the end then what is the solution or what is we are trying to achieve towards by holding liquidity. For example, if the assessment of the bank shows that this particular product or this particular line business line item is giving me a high liquidity charge, means I have to hold a high liquidity. So that means either you need to price those higher liquidity in those assets, so then it will reduce so you are properly pricing those risks. Or if this is not possible, or if this is not the path you want to go for, then you should reduce that particular portfolio so that your liquidity requirement will get reduced. So in that way this ILAP acts as a exercise in which you will be ultimately move towards pricing of your liquidity risk accurately or reducing your portfolio so that the undue risk which you are taking is not on the balance sheet of the bank. In ILAP, there are few set of particular sections which we are dealing with. First is on the governance aspect. The governance aspect is something which a regulator is very much keen on, whether it is a capital or liquidity. They want to have a proper liquidity risk management framework, and that particular framework should be approved by the board. And now it is assumed that all these regulatory reports like ILAP or ICAAP, RRP, IRBB, all those regulatory submissions should be approved by the board. The board is considered as the ultimate responsible for institutionalizing a proper risk management framework at the bank. Next aspect is the funding strategy. The funding strategy should be aligned with the overall strategy of the bank, the economic outlook what they having. For example, if the economic outlook overall economic outlook is such that we assume that there will be enough liquidity in the market, and the bank should project that particular liquidity in its funding strategy. Or if the economic outlook is such that there is a general consensus of increase rate in the market, so that should be factored by the bank in its funding strategy. Or by funding strategy in its funding plan for liability planning. Next is the liquidity assessment. In liquidity assessment, we will go further in detail. In liquidity assessment, the main idea is to assess the liquidity risk on each of its line item. And here, this is slightly different from ICAAP. In ICAAP, we are generally focused on the asset side, but in ILAAP, we are focused on the liability side plus asset side, because it can happen that the liquidity risk mainly will arise from your liabilities because they will get withdrawn. Maybe the depositor will withdraw their money, or the bondholders will ask you to buy back your debt. But the way to provide the liquidity to those demanding situation will be through generation of cash, either by repoing of your HQLA or by selling down of your portfolio. So here the liquidity risk arises from the liabilities, but the way to mitigate this liquidity risk is done by your assets. So we have to analyze both your liabilities as well as asset in the ILAAP. Next comes the risk appetite. This is again a very crucial aspect. This determines under what level a particular risk level is overall appropriate to you. For example, how much deposit concentration is something which I as an institution is comfortable with, how much non-maturing deposits as an overall portfolio of the bank is I am comfortable with. The point of non-maturing deposits is quite relevant because these non-maturing deposits are the cheapest source of funding, but also because they don't have any maturity, the customer can come at any point of time and ask for their money back. So there is that risk and reward. So that's why everything needs to be factored in from the risk as well as on the benefit perspective. Next, a crucial aspect is of the stress testing, in which we factor the stress levels, what kind of stress might happen. These stress testing may come from the historical analysis, if there is any stress period which the bank has observed, or may come from other stress factors. For example, if there is not any stress period which the bank has, or there might be stress periods outside the country which they can be transposed here with some management judgment or with some overlay by the regulator. Next is the pillar 2 risk, similarly like ICAP. So here again, the Basel and the relevant regulator has prescribed a set of pillar 2 risk. This generally goes from 10 to 12. And these, the bank has to establish the outflow factor or the inflow factor for all those pillar 2 risks. And last is, and the second last is the contingency planning, because obviously after this stress testing, this will give you a number which needs to, in terms of the liquidity which the institution should be holding or not should be holding, which the institution should have access to. And then then it needs to be a preparation of contingency planning in terms of, okay, there is a stress, then how I am going to manage those stress, where what are my sources of funding, so that all those things will come into that contingency planning. And adoption is the last thing, in which we use of the ILAAP in the institution. For example, if we found out that a particular business line item of it, a particular funding profile is something which is not up to the within the risk appetite limit, so how you are going to manage that particular aspect, or how you are going to reduce the particular portfolio. So this is again the feedback loop kind of thing. If the ILAAP provides you that the risk which you are carrying is more than the reward which you are earning, so obviously you have to somehow change your strategy. So it is always a feedback loop kind of thing. Next slide, please. Yes. So this is that the liquidity risk management, which I was asking you, that it starts with the pillar 2 assessment, risk identification, measurement, stress testing, all those aspects like mitigation and control. So this should be a part and parcel of the overall strategy. Then there is also a risk infrastructure, in which we have talked about the governance structure, all the policies like the liquidity risk management policy. The transfer pricing policy is a very crucial one, because this is one lacuna which has been observed in most of the banks, and not clear cut pricing of the liquidity risk. And and then the risk process and controls. For example, if there is any breach in the limit or something is coming nearer breach, what should be the steps, where should be highlighted. So all this comes under the risk governance or risk infrastructure aspects. Next is the risk of, in the risk appetite limit, we should have a limits for the pillar 1 liquidity ratios. These are anyway given by the regulator, that LCR, NSFR. In some countries, we have seen the loan to deposit ratio or the liquidity ratio. And generally, these limits or the board limits which individual bank follows, they follow at a higher level what the regulator prescribes, so that to keep a buffer. And then on the pillar 2 risk, the concentration limit, concentration means the top 10 depositor concentration, or the structural mismatch limit in the liquidity gap limits, or the other stress ratio. So all those comes under the risk appetite limit. So in the liquidity risk management, there are 3 or 4 aspects. One is that the risk reporting, the liquidity risk management process in which we follow identification, measurement, monitoring and control, and then the risk infrastructure, and overall everything should be governed by the risk appetite limit of the bank. And this should be a part of the business plan, and this should not be a independent aspect. This should be an integrated thing of the business strategy or the bank strategy. Next slide. Yes. So next, after that liquidity risk management, this is the liquidity assessing of liquidity requirements. So this includes the minimum pillar 1 buffer, obviously the LCR, NSFR, all those things, and the static balance sheet gap. This is basically what we are trying to assess here, because on banks generally borrow short and lend long, but they keep a certain level of cash or a high quality liquid assets in the short term bucket. So the structure of the bank balance sheet is in the short term profile, they will be in cash surplus. In the mid term profile, they will be in cash deficit. And again, in the long term profile or long term maturity buckets, they will be cash surplus, because most of the assets will get matured. So they generally do that approach and continuously monitor those liquidity gaps, and ensuring that the nearer liquidity term buckets remain positive, while and they continuously gets rolled over. And this is the way these entire banking or that banking system works. And so this is that static balance sheet gaps, and to overlay in on it the assets on the liquid behavioral factors. For example, generally we observe that the retail loans will have some prepayment effect. So then this based on that static balance sheet there, we are overlaying our judgment. Obviously this judgment is based on the historical behavior. So then we can see that though that the liquidity which the bank is generating in some long term bucket, it can shift it to in the short term buckets. Similarly, from the corporate working capital facilities, we seen that they need to be assessed in terms of how much portion is in the core and how much is in the volatile. So again, this will shift some of the liquidity from the near term bucket to the farther term bucket. And off balance sheet items like the letter of credit or bank guarantee or undrawn commitments which we have given to our customers, so they can come at withdraw at any point of time, because this is the commitment which the bank has given. So again, that will shift the short term liquidity, available short term liquidity, into creation of long term assets. And in on term deposits, this can happen that the customers can come, or some customers can come for their early termination of deposits. So again, this will create a liquidity requirement in short term buckets. So we see that a simple static balance sheet gap will not give a color or will not give a true picture of the exact cash flow mismatch or cash flow behavior which the bank will be observing. So there are lot many items, assets, liabilities, which have a potential to shift the cash flow profile. So all those aspects which I have just mentioned are the liquidity behavioral analysis. So this is another aspect which is mainly much focused by the regulator, that you should do that liquidity behavioral analysis and find out what is the actual or the projected maturity profile which you will be having. And yes, please, next. Yes. Then is that the liquidity risk appetite. We have also certain discussed this to some extent. Like the liquidity risk appetite, there are something which obviously needs to have, that you must maintain a healthy liquidity position, and obviously there must be like some indicators. The indicators may be the LCR, NSFR, the liquidity adequacy ratio, or the loan to deposit ratio, the liquidity gap. There are various these are the metrics which generally the banks follow, and there is merit in following these individual limits in multiple limits. For example, one can say that if LCR is saying is giving you the comfort that within 30 days you are at 100% level or you are at 110% level. So that means for the projected outflow of let's say 100 million in the next 30 days, you are keeping a cash or cash generation sources of 110 million. So yes, you are good in the 30-day bucket. But it can happen that the outflows are happening within the early part of the 30 days, or it can happen that you are not able to monetize all those HQLs. So that's why we are going to into the liquidity gap. So all these different matrices have their inherent value. That's why we generally focus on 3 or 4 ratio to give it a holistic view of the liquidity risk which that bank has. Another is on the robust funding plan. Through robust funding plan, we ensure that the bank should not focus on one particular funding sources, even if it is the cheapest source of funding. The bank should diversify its funding across customer, across tenure, and if it is in a multi-currency balance sheet, then those funding should also be raised into multiple currency. Otherwise, there is a chance of a cross-currency mismatch risk increasing, and that comes under this funding diversification. In CFP and early warning indicators, we have already seen that the contingency funding plan should include the amount as well as the sources of funding which can be raised at a short notice, and there should be a well documented report. And early warning indicators like for example LCR and SFR, these are reports which provides the projected outflow and inflow within the next 30 days. In early warning indicators, these may be a sudden drop in the bank stock price, which can give an indicator that there might be some problem which maybe a treasury team is not able to see, or which maybe we are not able yet to see. Or for example, another indicator might be if there is any negative news in the local newspaper, or because nowadays what we are seeing, that even a small tweet can create a havoc in the system. So all those early warning indicators, for example, if there is a very much demand from the customers to prepay their deposits, so this might be a alarming signal for the treasurer. So all those early warning indicators will also help in finding out if there is any impending situation or impending crisis which might be coming for the bank. Then the management action plan is a part of the stress testing, in which whatever the stress testing will give you, this is the liquidity which the bank might be short of if there is a stress. Then the management action plan should be okay, this is the stress and these are my sources of funding. But these management action plans should be such that the bank should be confident and yes, that they will raise that amount of funding. But if the management action plan say that this is the amount of funding which I am not able to raise, then obviously they have to go again back to the ILAAP, change the funding structure and rework those stress testing numbers. So in that way, this is a feedback loop kind of thing, that you do that funding strategy, you do your stress testing, and if the numbers or the stress testing numbers are such that it is not within your risk appetite limit, then obviously you have to change your funding strategy, you have to change your balance sheet structure. And this is the liquidity buffer. Liquidity buffer should be sufficient for covering your pillar 1 risk. Pillar 1 risk means LCR and SFR, and all those pillar 2 and stress requirements which we'll be seeing later on, or the pillar 2 risk which the regulator has prescribed for your. Yes, please. These are the just a list down of all the pillar 2 liquidity risk factor. For example, there might be a delay in the asset payment, which is not exactly the default of assets. This is only a delay in the payment, because in LCR we are mainly tracking a 30-day inflows. There may be an off balance sheet risk, potential outflow on account of LC, letter of credit, letter of guarantee, drawdown of committed facilities. The market volatility risk, this impact your the market value of the liquidity buffer of HQLA on which you are relying to generate liquidity. So this covers the asset side of the balance sheet. On the customer concentration risk, this can occur on the, if you are relying on few customer means of few depositors to provide most of your funding, then you are very much dependency on that particular customers. If there is any risk in that particular industry, then your funding might get disrupted. In transferability risk, this is if a particular organization has a multiple branches. By branches I mean to say multiple operations in different currencies, then there is a risk of transferring the HQLA from one entity to another, and sometimes it also leads to that trapped liquidity. Similarly, liability runoff risk means that non-maturity deposits getting out of from the bank. Deposit pricing risk, the bank has to pay a higher premium. So similarly, like the funding liquidity risk, if the tenure of the particular transaction can be increased or decreased by the customer, for example, they can come for prepayment of that prepayment of that deposit. And market access risk, if there is a reputational loss of the bank or the credit downgrade, and due to which the bank is not able to access the market, means the bank is not able to access funding from the market. So these are the various pillar 2 liquidity risks. And there is another set of risk given by the regulator. This is a long list, so I have highlighted only a few of them. So these pillar 2 liquidity risks the bank should assess in their ILAAP and see whether it is a material for them. And if it is material, obviously, then you need to provide liquidity, all those aspects. Yes. Yes.
Gaurav, I
Yes.
think we are running out of time, so
Oh,
I'll request you to in next 2 to 3 minutes if we can sort of
okay. Sure. Sure.
conclude the session so that we can also take chance to answer the questions, please.
Okay. Sure. So this we have almost discussed the liquidity risk stress testing. This is general guidelines that it should be a relevant. Generally, what we prescribe that the stress should be dynamic in nature. For example, dynamic in the sense it should be a bank specific, market wide, and a combined scenario, just like the ILAP. In the interlinkages, this should be, for example, a credit crisis might leading to liquidity crisis, and it should be at least of a 3 to 4 months of tenure, so that the bank can, it starts with a severe scenario, then on a moderate scenario, then on a mild scenario. So there is a laddered way of approaching of that particular stress. Then the market response will be how much cash or how much deposits or how much funding the bank will be able to raise in that particular time period. Yes, please, next slide. Hmm. Yeah, this you can escape. This is almost we have covered. These are the various set of scenarios. For example, in we can have multiple market wide scenario, we can have a bank specific scenario, a political turmoil which might lead to a higher corporate or retail delinquency, or there may be a reputational risk event which might lead to an outflow from the customers, or maybe there is a bank credit downgrade, so then it might lead to not able to attract deposits from the wholesale market, or might be need to paying a higher premium of deposit. So these are various set of scenarios which a bank can consider, and then depending upon its own balance sheet, its own products and structure, they can create their own stress events and scenarios. Yes, please. The last thing is the contingency funding plan. As I mentioned that it should be a documented kind of thing which has all these aspects, that these are the sort of early warning indicators, these are the modes of funding which we need to raise, these are the management coordination, and it should be prescribed, or it should be prepared in such a way that it should be a rule book kind of thing, that yes, okay, now indeed we have a stress, now these are the roles and responsibility of each individual, these are the ways of funding, these are the communication we need to make to our stakeholders. So that is a separate topic. I think we will need some more time for discussing the contingency funding plan, but the aim is to have a rule book kind of thing which will help the organization in raising funds at a short period of time. And this is the some sample kind of thing that in a contingency funding plan, from what particular sources you can raise funds, and under what time period. Like in a HQLA, you can definitely do a repo within 1 week, within 1 month, or within 3 months. So all those type of answers, like say. And similarly, if we are using a senior, like for example, a strategic might be, if there is a liquidity crisis and you want to increase your funding by issuing a bond, so obviously you cannot issue a bond within 1 week or 1 month, you have to wait till 3 months or maybe a longer time horizon. So that type of contingency funding plan which gives you sources of funding and also the timing with which you might be required to raise that type of funding. So this is only a brief description of that contingency funding plan. Next coming this is the last slide. then how to manage the liquidity during this pandemic scenario. Then the first thing which the bank or the regulators are also focusing for each of these banks is to maintain the franchisee viability so that the banks continue to lend. They are asking to recalibrate the stress testing scenarios. Obviously, as of now, we are in a liquidity surplus situation because all those the support given by the central bank. So the HQLA buffer is already elevated, but once the situation normalizes, the banks need to get out of their comfort zone and work towards reducing this HQLA buffer, because then the requirement from the fund lending side will increase. And on the reporting side, one suggestion is to increase the frequency of ALCO meetings and reporting. And needless to say, the ability to perform integrated data analytics, because all those things are quite dynamic in nature. We cannot stay doing that analysis once a year and then keep it that way. We have to continuously refresh, or at least on a quarterly or on a half-yearly basis, refresh our stress testing numbers, refresh our dynamic cash flow, all those things. So this is a brief introduction of this ILAAP. Yes, I am done, Prateek. Thank you.
Right. So thank you so much, Gaurav.
Thank you so much. Yeah.
Yeah, thank you, Pratik. So, Gaurav, we have, I think,
Yes.
in total 4 questions from our attendees, 2 of which I can see are related to ICAAP and stress testing.
Yes.
So, allow me to answer the first couple of questions, and then probably the next 2 I'll pass on to you.
Yes.
Okay.
Yes.
So, on the first couple of questions, the first question says that how do banks ensure that a scenario simulated during the ICAAP and stress testing is severe enough to cover all the potential risk and is yet plausible? Now, this has to do with the scenario designing and the estimation or the measurement part of the whole stress testing bit. And this is actually a very valid and a very commonly asked question. So during the scenario designing, there are 2 ways in which a modeler or the scenario designing team may deliberate upon. One is the subjective outlook over a certain scenario. So for example, one of the most common ways is that banks during the designing of a scenario choose the severity or the extent of scenario in a manner that it mimics or replicates one of the past scenarios. So you may think, okay, my mild scenario will be a 1 in a 20-year scenario. My severe scenario would be a 1 in a 100-year scenario. So you can choose one of the older scenarios, like the recession of 30s, the recession of 80s, the 2008 crisis, the oil dip of 2016, and so on. So you can have one of the old scenarios being benchmarked so that you ensure that at least to that particular scenario you cover yourself. The second way to do that is through different statistical simulations that are run. So for example, from credit risk perspective, you can have the credit risk VAR or the economic capital through a series of simulations which are run across multiple iterations. You can actually determine over the historical data pertaining to industry and the bank what could be at different confidence intervals, different levels of stress that would be possible. So you can actually choose from those levels what would be your tail risk. Tail risk meaning those risks which are uncommon, plausible, but are very high in impact. And through provisioning as well, you can also choose different levels of your ECL provisioning, which are PD, LGD, and EAD. So for example, the easiest one would be to choose a level of your probability of default in such a manner that it is plausible to the extent but represents a close to 1 in 100 or a 1 in a 50-year scenario. So you can look back and see that what was the systemic or industry-wide probability of default during 2008 crisis or during 1980s. So that's a good reality check that the banks should do. Now, the second question is...
Kautuk, I think if we can take the questions from chat first, because we know who has asked them, and then
sure.
we'll move to Q&A.
Yeah, I'm taking the one from the chat. I think it was asked as 410, but as I can see,
Okay,
it's an anonymous attendee.
Yeah, so we can take the questions from the chat first, and then we'll answer those questions either by the session, or we can send the answers by the end once we after the webinar.
Sure. I'm just answering the second question now. So
Okay.
the second question basically. Yeah, so the second question suggests that during the ICAAP and SREP, how do the regulators ensure that all the risks which are assessed at a bank level do not get translated into a systemic risk? Now, for that, I think we need to understand how and what all dimensions does a systemic risk component has. So systemic risk is basically spread across, one is the cross-sectional dimension and the other one is time dimension. Now, as Gaurav also discussed during his ILAAP discussion, that there are two types of systemic risk we are looking at. Firstly, from banks which are too big to fail, and secondly, from banks which are too integrated or too interconnected to fail. So taking the former, taking the latter first, as we know, our financial system is a network of interlinked balance sheets, and there are daily transactions which may impact each other. So there are cases in the back that the regulators need to be cognizant and aware of, that even if a bank is not say a DSIB or a domestically systemically important bank, it needs to see the interdependencies across that particular institution and the other. So for example, a good case study would be Herstat, Illinois study, which would show you that a bank, through its inter-bank settlement risk, had spur out a risk which eventually spread through the entire system. So that's a good example of the first dimension of systemic risk, which is cross-sectional. And when regulators are evaluating the banks, it needs to check that particular financial institution's dependence on other balance sheets, and also the cross-sectional linkages between the system. The second example is those banks which are too big to fail. So for example, again, taking the example as asked by our attendee, that what all pillar 2 risks can become systemic risk. A good example of that is reputational risk. In 2008 in India, we observed that ICICI, which is the largest private sector bank, due to certain triggers which were related to reputation risk, had a run on the bank. So not per se it was due to the actual liquidity risk, but then reputational risk became a liquidity risk for the bank, and eventually it threatened the liquidity risk of illiquidity condition of the market as a whole. So in that condition, also there are multiple cases of deposit runs on the bank, but the regulators need to see the size of the bank and also the systemic importance of that particular bank. So those are the areas that a regulator needs to be cognizant about. There are also smaller banks, but for instance, a smaller bank in terms of its market position and all, even if there is certain risk or threat, at times it is limited to that particular entity only. So only in two dimensions, one is cross-sectional and one is time and the size of the bank, is the regulator need to be worried about the systemic risk. Over to you, Gaurav, on the other
Yes.
questions.
So one question is, yes, do you consider structural FX risk as parallel one or pillar two? And obviously, please give reasons. So what we have seen, for example, if we consider the LCR, so LCR, the regulator asks you to compute LCR on a consolidated basis as well as on an individual currency basis, provided that particular currency is constitutes more than 5% of your balance sheet. In that way, the regulator is giving some leeway or consider that FX risk as a pillar one risk. But in the ILAAP, we again assess that particular risk, because again, regulator asks you to assess that FX risk as a part of the balance sheet mismatch risk. For example, if you are funding some of your, not some, if you are funding a majority of your particular currency, either assets in a currency by swapping another currency or in your home currency. Just to take an example, if there is a USD based bank whose main liabilities are in dollar, but they are creating assets in euro, so there is a cross currency mismatch risk which they are doing by transferring or swapping USD to euro. In that case, the guidance from the regulator is so how well you are prepared if there is a stop, if the that FX market are come to a halt, or if the bank is not able to swap those currencies. So in that way, the structural FX risk is somewhere factored in as a pillar one risk also, as a part of the LCR and NSFR while you are computing these ratios on a separate basis, and also as a pillar 2 risk while you are considering it as a part of the balance sheet mismatch risk. Yes. Next question is, should a bank apply the same rules for LCR and NSFR, especially with regard to computation in the respective currencies, if it is funding a significant portion of its local currency assets with foreign currency long-term borrowings? So again, the answer is the regulator does not provide you any leeway in terms of choosing the stress factors or choosing the outflow or inflow factor. And that is effectively a fallout of what we have just discussed in the FX risk. The main idea here of the regulator is, if you are taking exposure in particular currency, you should be able to generate liquidity in that particular currency by assets from that currency. For example, if you are raising funds from foreign currency, and it can happen that the assets which you are having right now in foreign currencies are not to that limit. So it will show a breach in your LCR for foreign currency, while it will show a very high surplus of LCR in your local currency. And because there are limitations in terms of how much benefit of one currency HQLA you can transfer to deficit of another currency. So in that way, your overall combined LCR will not be the algebraic sum or maybe the weighted average LCR of your LCY and FCY. So in that case, the regulator do not provide you any leeway in terms of tweaking in of those outflow or inflow factors, and that's the main reason you are assessing that particular risk in your ILAAP. Yes. You can also run a reverse stress test to give an indication on the runway you have before you get into trouble. Yeah, so this is the next thing which the regulators are asking for. So for example, initially they started with all those LCR and SFR guidelines, then they come with the ILAAP, and now the new guidelines, or the not the new guidelines exactly, now the new thought process which is coming out, the reverse stress testing, in which you should arrive at the scenarios which might lead to a situation where you are breaching your regulatory limit or your entire business model is not sustainable. So that is the last thing which the regulator is asking you to do, because in that way there might be some scenarios you have not considered in your stress testing, but these are quite possible, or these are quite plausible kind of scenarios which can happen. So again, that reverse stress testing, which is a new domain or a new coming regulations from many regulators. So this will provide a new dimension to this entire stress testing, and also that to scenario formulation. Yes. Is there any other question, Prateek? Is I missed something?
No, I think Gaurav, it's fine, and thank you so much, Kautuk and Gaurav. If there are any questions left, we have recorded all the questions, and we will be responding to all these questions in the subsequent mails. While we also thank everyone, we will also be sharing the slide and the presentation done today. Would be available on our YouTube channel. The details would be shared to you shortly by tomorrow. With that, thank you so much. Thank you, Mr. Osama, for joining us today and providing us with your opening remarks. We thank everyone to take their time during the working day and joining us for this webinar. So thank you so much. Please stay safe. And by this, I end the webinar. Thank you so much.
Thank you.
Thank you. Thank you, everyone.
Thank you.